All right.
All right. Well, welcome to Totally Timely Topical Tokenomics Thursdays. We got to find another T for this one, Hunter. Today I'm going to cover real-world assets on chain, things like mortgages, debt obligations, inventory positions, and an overview of a company called Centrifuge. Their DApp Tinlake, a really cool price oracle called Paperchain, and then their integrations currently with Maker DAO and Aave. So there's a couple different companies for doing real-world assets on chain. Centrifuge is right now the leader, so we're just going to cover them. But if you are with or investing in any other protocols like Robin Land or Milo, there are other companies who are doing it, but Centrifuge is kind of the industry leader, so we're going to stick with them for this presentation. All right, so the real question here is, how can traditional finance leverage the power and liquidity of DeFi, and how can DeFi capture this $20 trillion debt market? The entire crypto market cap right now is just over $1 trillion. Could you imagine if you brought $20 trillion of real-world assets on chain? DeFi would go absolutely bananas. But so the real-world assets being used right now on chain are things like mortgages, invoice factoring, royalty payments, and small and medium enterprise level investments. So a quick overview of the company. Company is called Centrifuge. They built themselves on Substrate, which is an enterprise-level blockchain solution built by Gavin Wood, one of the creators of Ethereum. But it's just a way for companies to make their own native blockchains. They have their own token, CFG, and they're the ones who are responsible for kind of onboarding all of the new asset partnerships with asset originators like mortgage companies or invoice or debt companies. They create zero-knowledge NFTs, and then they bridge all their assets from their native chain over to Ethereum on their DApp called Tinlake. And Tinlake runs on Ethereum. They use a CVT collateral value token, which we'll explore in a little bit. And they've integrated with Maker DAO and Aave, and they have their own native lending market. Since the tokenomics talk, I figured I'll put a little tokenomics in here. The CFG token that runs the Centrifuge chain, it's pretty unremarkable. It's a standard governance token. It's used for proof-of-stake validators. You pay transaction fees. So if you are a mortgage company putting assets on chain, you're going to need to pay them in CFG tokens to get them minted. They do about 8 CFG tokens per day for 10,000 DAI invested in any one of their pools. So you're going to get some native token rewards for investing money in a project. You got to hold it for 30 days to get the rewards. They've got a 3% inflation rate, and their goal is to keep that burn rate pretty much equal, and they will adjust it as they see fit and how they balance the network out. But the goal is to keep the 425 million CFG tokens pretty standard and the same across the board. Since they are a company and not a blockchain originally, their tokens are much more concentrated to core contributors and their initial investors. And then almost all the rest of it is being used for grants, ecosystem development, and then only 9.5% of the whole supply was actually sold out to the community. So that's the CFG token.
Joking, I have one question. Is Substrate like part of the Polkadot ecosystem or something?
Is Substrate?
Yeah.
No, Substrate is its own thing people are building with. What their Centrifuge is trying to actually get, I think they won a Paperchain spot, and they're trying to migrate themselves over to Polkadot.
Okay.
But yeah, that's kind of an enterprise blockchain solution.
Thanks.
No problem. All right, so here's how the sausage starts to get made, right? How are we actually getting these assets on chain? So in this example, we're going to use a tire company and an invoice. So just say Tire LLC over here on our left, they make tires. We got Big Car Inc. to the right. They own a fleet of 1 million rental vehicles, and they want to order 100,000 tires. This will be a multi-million-dollar invoice. Tire LLC will then get this invoice from the customer, and they have to produce the tires, fuel the factory, pay all their staff, and run everything while they're making the tires. And even after they deliver the tires to Big Car Inc., they still might have to wait 30, 60, or 90 days to get paid based on how their invoices work. This is how invoicing in the industrial world goes through. So Tire LLC might be spending a year building this giant order. They're going to need liquidity and capital to keep on running their operation. They're going to need money in their hand to pay their people. So this is kind of where this invoice financing comes in. It's a bridge to get them from order to completion with money. So say they want to get DeFi financing. Now the banks won't give it to them, so they're going to go look for the blockchain to get it. What they do is they send this invoice over to Centrifuge on their P2P market, P2P network on their own chain. Centrifuge looks at it, goes, cool, this is a good size. They go to Big Car Inc., they verify it. Big Car Inc. will sign saying that, yes, this order is valid. Yes, there's money in the bank. Then they'll go ahead and they're going to hash this document onto the chain. This is like anchoring it. So they're going to anchor this information to the chain. Big Car Inc. and Tire LLC will both sign the transaction on their P2P node. And then Tire LLC gets the ability to go ahead and then mint that NFT. So this is just getting it on chain. We're not showing how it's being used yet. This is just the process of getting something to chain. So they're hashing the network, making sure all the information is correct, and then they're anchoring it. Just a quick little technical of the privacy. So this is a zero knowledge NFT. I wasn't aware this existed yet. Obviously, zero knowledge proofs make sense. So why not make them NFTs? There's some reasons why you wouldn't want everybody in a public blockchain to know this entire contract. Maybe your competitors are looking at it. Maybe you're publicly traded and that information would be insider trading without signing an NDA. So what this does is they hash the information separately. So you can go ahead and query the blockchain with one piece of information and then understand that that is the same contract they're saying it is on chain. Just a way to hide and obfuscate all the information in one contract. But yeah, just one little thing about Merkle roots and Merkle trees. I think Hunter is probably the only person that's really deep into this. But if you want to read about it, it's interesting. So the number one thing I was really confused about when I first did this research was that how do you actually value this asset, right? When you're talking about DeFi, we have price oracles for all of our crypto native assets. How do you confirm something in the real world on chain without an active price feed? So this is how they got around it and how they figured out how to make sure it was secure. So you have the asset originator, the person who's creating the product. You have the supplier who's going to be buying it. Then you have an underwriter on the side of Centrifuge who's going to go ahead and look at this, look at the companies involved, and they're going to go ahead and underwrite that risk. They're going to go through and figure out what's the interest rate to make up for the amount of risk you're taking for financing this debt position. Then they send it to a third-party auditor or rating system or a rating agency or evaluation firm. And this is somebody else in the process to make sure that everything on this and the underwriting is all secure. So basically you have 5 parties who are looking at this contract to validate the price, which kind of breaks the entire decentralized ethos, right? Like blockchain, we're using a trustless system. In this scenario, we actually have to trust somebody. We have to trust these parties that they're not colluding, they're not lying, and they've done their jobs properly. So this is a glaring issue with the real world asset market on chain. So why are we doing all this? Why go through all this trouble? Well, the problem comes in the cost of capital mostly. So if you are a Global 2000, you're Tesla, you're Google, you're Apple, you can borrow money from banks at massive amounts at a penny above prime. They're happy to throw money at you, you have it. But if you're a small business with not a lot of assets, they're going to charge you greater than 15% for bridge financing. And this is mostly because not of the risk, right? Like small businesses, the default rate on these are low. It's only 2%. Really, the issue is the time and the energy. For the bank to go ahead and underwrite a $100,000 invoice, it's peanuts to them. They're not making enough money off of it to justify the amount of work it takes. So they charge a bunch of extra money to make it worth their while, not for the actual risk. So access to capital as well. A lot of banks won't lend to small and medium-sized enterprises. So having DeFi capital makes life easy. Same thing with liquidity. And the last one is that payment lag time we talked about, right? Like people are waiting 30, 60, 90 days for their invoices to get paid in the commercial world. But down here is royalty payments. I thought that was absolutely crazy. If you make an indie film on Netflix, you're waiting almost 3 years to get your payout, despite knowing how much you're going to make. So every stream is counted and shown for revenue. Spotify, 90 days to get your money out. So this bridge financing helps people get their money up front by paying a small fee. I'm going to pause for a second. Any questions before we keep on rocking? We just kind of showed how to get things on chain. I'm going to show how this actually works in reality. But before I keep on fire hosing you with information, I figured I'd stop and let you ask any questions if you got them at this point.
Hi, Joe. It's T. Can you hear me?
Yeah, what's up, man?
Like as someone who actually operates in this smaller business world, like I guess I'm just trying to imagine this is $250,000 and not, 25 million. So as far as me looking at this, I'm cool to follow along with this because it does apply to someone who's looking for $250,000 and not in these larger amounts. Is that right?
Yeah. It makes it easier to get small financing.
Yeah, cool. Okay, thanks. Yeah, this is good. I'm a little bit slower on this, but I appreciate the slides and the way you're doing it. So this is great. Thank you.
Thanks, Steve. Appreciate you. All right, so let's kind of walk through real quick, just a one slide, just in people who are not super familiar with Maker DAO and how their vaults work. We'll cover that first. The rest of it will make sense. Maker DAO, DeFi, the original DeFi protocol. It's a lending and borrowing network. It's an over-collateralized debt position. So essentially, if I have $300 of Ether, I can go ahead and put it in one of their vaults, and I can borrow up to $185 in DAI against that. If my collateral goes down to the 185 level, I get liquidated plus a small fee. If that Ether goes crazy and doubles in price and 600, I still have my 185 DAI. I can repay the loan, open the vault up, take my collateral back out. And then liquidated happens via auction, which that'll matter later. Anyway, so quick overview of Maker. How does this work with real world assets? So we're going to use New Silver. This is one of Centrifuge's partners right now and one of the credit facilities that are operating. They do fix and flips real estate loans. So 1 to 2 year loans for people who want to buy and then renovate a property. So say we have this $300,000 house, they can go ahead and put the NFT of it in Maker and take out $185 worth of cash back out. And they can use that to go ahead and finance the flip to make sure the house is all good. And then when it's sold, go through the whole sell escrow process, money goes back into the vault, NFT comes back out, everything is closed out. So here's the actual process, how the covers a lot of the technicalities of how you value this and how the pricing feed works in a smart contract. So the borrower takes their NFT they minted, they drop it in the tin like dApp. That dApp gets locked into the contract. The contract then prints the CVT collateral value tokens. The reason why is 721 ERCs, NFTs, they can't talk to smart contracts with value. They can't present their value to the smart contract. So using this collateral value token was a way around that. So basically it just means every dollar of the contract gets printed $1 of CVT token. And these CVT tokens aren't actually traded anywhere. And there isn't currently a secondary market. One day there might be, but that'd be interesting how that would work because then you have to fractionalize it. So I think for now they haven't wrapped their heads around how to make this work. It's kind of mind-boggling. But anyway, so these CVT tokens get locked into Maker or Compound or Aave, and then you can borrow against it. So they're borrowing the stable coin, goes back to the wallet, and now the borrower is getting their stable coins. Everything that happens in the dApp, the customer is not touching that. The customer is only touching the left and the right side of this process. The middle is just happening automatically in the contracts. So that's the sausage making part of all this. Now, custody legalities and LLCs and how all this works. I'm not sure if he's on a call or not. My buddy Charles asked me earlier, how do they legally enforce this on and off chain? So you're not actually borrowing against a single mortgage. You're borrowing against a pool of mortgages, right? So New Silver, in our last example, they're the originators of this debt. They have written all these mortgages and they put them out there. They're going to take all these mortgage contracts and they're going to put them in the ownership of an SPV, a special purpose vehicle LLC. And this LLC is overseen by Real World Asset LLC, and it's just part of Centrifuge, part of Maker, part of the company. So it's kind of like the meat space version of a multi-sig wallet. So these guys actually hold the assets themselves. They then print these debt instruments that has very specific asset language that goes over the process of what happens with an off-chain liquidation, like in the event they have to actually sell the house to recover the cost, or in the chance they have to do an on-chain liquidation and liquidate the DAI. So this whole process goes through is that all of these debt instruments are being printed from one company, and that one company now has a credit line with Maker DAO, and that credit line is what's being pulled, right? So if Maker DAO, they put this LLC up and it has $100,000 of mortgages inside of it, and they can borrow 50,000 DAI against it. So you're not borrowing against a single mortgage, you're borrowing against a basket. And this is the legal purposes, right? So they have to liquidate something. It's not like the vault is going to get destroyed because one mortgage defaulted. One mortgage defaults, the LLC just gets written down in value. Their credit facility is lowered on the Maker side. And as long as there's capacity, there's no problem. What happens is when there's not capacity, then we get into the legalities of off-chain liquidations. But they've done a really good job of setting this up from a risk parameter standpoint. So the vaults themselves in Maker DAO, they've got the underlying collateral on orange. Then you have the underlying equity of what it's worth. So again, $100,000 mortgage, say they're saying there's $90,000 of equity. Then they have the LLC, that special purpose vehicle. They're letting that down by 90%, and they're putting that in the Maker vault, and then they keep an extra 10% buffer on that. So they've layered 40% of cushion in this whole process to avoid the fact that they're going to have to liquidate. And that's why they're only borrowing 50% of the value. There's all these different checks and balances to make sure it doesn't happen. Why this works so well with a debt instrument like a mortgage or an invoice is because the value is not changing, right? Like your house might yo-yo from the cost of, $100,000 to $200,000 thanks to our recent inflation. But your mortgage didn't change. Your mortgage stays the same. So there's no need for active price oracles in this because the actual value of the underlying collateral is always known. It's a known figure. Any questions? Getting into regular finance world.
So I do have a question. This is Mariette. So I understand how SPVs work. Are they bundling the debt as well?
Yes. One credit facility is being used, all of those mortgages or all those invoices bundled together.
Okay. And then how do they do the due diligence on the assets? Because I know one of the challenges with SPV is basically taking on bad debt within the SPV itself.
There we go. This is the original value of each asset, and then the LLC itself is valued by the underwriters and the auditing agencies.
Okay. Got it. Thank you.
No problem. I got the legal minds in here too, keeping me honest. I love it. Questions? There is a slide now. So I've got 2 more examples after this as well we can run through. If anyone wants to go through the process, this is kind of the meat and potatoes of the what's happening on chain and off chain.
Joe, so this is like via an LLC. So this is obviously in the States. How does this work internationally?
They haven't done it yet. So only US only at the moment. So I'd be curious to see how it works in international law when it gets done.
Cool. And then just another question too. Have you followed along? Like I know a little bit about Citadel. It's like the Singapore or Hong Kong company or something that did their launch with the whales thing. Have you followed that at all, or does that apply to this, or is it quite different? Because I know they also have an SPV as the vehicle that sort of connects the two worlds.
Yeah, there's an interesting Web3 SPV. I need to see if I can find it real fast for you. It was in. I'll shoot it out later. There is a Web3 native SPV they're using. I haven't dug deep enough into it to have an opinion on it of how it works from a legal standpoint, but there is a way to now to do like Web3 SPVs. So the DAO is actually the owner of the underlying collateral. But again, I'm not sure. I'm not sure if maybe Mariette, our legal homies here, have an idea of how that works, but I'm not sure how the ownership of DAOs work when it comes to real world assets.
Well, it depends on if the DAO is wrapped.
Like an illegal entity?
Yes.
Gotcha. So TBDT. So let's go through actually the TinLink itself. This is their native app, and I'll show you how their pools work. So you have the asset originator we covered. They have their assets. They tokenize it. The token goes to TinLink, and lenders can go ahead and put money into these pools and get interest paid on it, and lending and borrowing against their real world assets. We're going to go into tranching for a minute, or if you're in the VC world, mezzanines. But they use junior and senior tranche debt here, and that's just a fancy way of saying that there's a low risk, low yield side of the bet, and then there's a high risk, high yield side of the bet. So how TinLink does this natively is they've got 2 tokens inside of each deal, right? There's a drop token, which is the senior level debt, and this is the only one available to the public. You and I can't go out and buy TIN tokens. This is only for Maker DAO, Aave, and TinLink. You can only buy this drop senior level position. But it's a fixed APR. They run for 30 days, 90 days. Some of them are a year, some are 2-year contracts. They're auto compounding, so they're sitting there, you're getting money on your money. They've got set terms, and interest is paid only when the credit line is utilized. This is an important safety tip when using one of these pools. They might advertise 8% interest and $100 million credit line. We'll say to New Silver again for the example. If New Silver isn't utilizing any of that credit, you're not getting paid any interest. It's only getting paid when it's being utilized. So those credit facilities are revolving. So people can come take their money in and put it out, borrow it, repay it, and you're only getting paid when there's there. But luckily, their dashboard shows you how much room there is and actual capacity. And then they had the TIN token. This is the junior level debt, higher yields, takes their losses first. But they get the spread, right? So if they're, say, the company's paying 10% interest, but you're only getting paid 8% from the drop token, this junior debt's getting that 8% plus the 2% plus any fees charged, financing fees, liquidation fees, stabilization fees, all the stuff you pay on your mortgage every month. All that stuff goes to the junior tranche. So they're getting paid out higher. But on the offside, sorry, I'm echoing really bad.
Can you just repeat this point? How does the TIN token get its spread? Could you just repeat that, please, if that's not much of a bother?
No problem. Yeah, so the TIN token itself is the junior debt, right? So say the deal has 100% capacity of the deal. There's 80% of this senior debt that is being paid a fixed APR on what it is, right? So I'm saying, give me your money, I'm going to give you 8%. Then they might charge the customer 10.5% to actually facilitate the loan. So the TIN token, this junior level tranche, is going to get the 8% that you and I are getting in our senior level debt. They're also going to get the extra 2.5% spread on the transaction. Plus, they're going to get all the fees paid out to them as well, like the origination fee, financing fee, stabilization fee. They get all that stuff. But the risk they take is that in case there's any drawdowns, right? Say we have 100 mortgages in this pool and 2 of them default. So rather than having 100% of the money available, there's only 98% of the money left in the pool because of this foreclosure or liquidation process. The junior debt is the ones who take those losses first. So the first 20% of any losses in the pool are paid out by them. So say the pool only repays 80% of the money, those TIN token holders, they get nothing. So they take the risk first. Now, if it has a massive problem, say half the money vanishes, the TIN token holders will get nothing, and the job token holders will also take a write down on their money as well in case of something really terrible going on. But the idea is, since you're bundling so many assets together, the likelihood of it having a massive problem like that is very low. But yeah, that's tranching. But yeah, this is only available to professional investors, people who are vetted with Centrifuge. What I thought was really cool was that the Centrifuge themselves, as well as the person who is taking out the debt, they're the ones who are usually involved in this TIN token part. So they're actually taking on a lot of risk for themselves. So Centrifuge is on the TIN side of all of these transactions. So they're taking first losses, but they're also taking higher rewards too.
I do have a question. So in some of the earlier slides, you were basically saying, and correct me if I'm wrong, that the assets will be liquidated in the event of something bad happening, which should take care of then the losses, and then the rating would obviously decrease. So what are some examples of losses that a TIN token holder would have to bear?
So usually it's write downs, right? With these massive credit facilities in normal banking world, as well as in this scenario, we'll say the mortgages again, that they'll do a write down. So say the fund has 100 million in it and they borrowed 50 and they have a mortgage go bad. They have to then go ahead and take the asset down. Rather than them liquidating it to pay the asset holders back, they can just write their own debt down. They can write down the difference of their capacity to what they owe. And as long as that's still in line, they're fine. Nothing really changed. The company themselves takes the loss. So Neil Silver Mortgage would absorb the losses usually on one thing to avoid paying liquidation fees. It's cheaper for them to handle it on their own side. If they want to do it on chain, then those legal contracts and the SPV come into play. And the SPV can go ahead and take the house, sell it, replace the debt, and pay everybody back.
Got it. Thank you.
No problem. This is an actual this is a screenshot of their dashboard from yesterday. So New Silver, we're talking about up top, their bridge real estate loans, they're paying out 4.16%. The entire pool has $29 million in it, and there's a capacity of 5.6 million more DAI to be put into this to get yield. You can put more than 5.6 million in, but you're not going to get any money on anything over that, or interest on anything over that right now. The branch series 3 is pretty interesting. This is like emerging market consumer loans. One of the companies in this pool is a motorcycle company from Singapore. They basically buy motorcycles and then they, just like a car loan, they sell them financed to locals who are using them for gig economy work or just to get to and from work. So it's basically motorcycle auto loans. Since it's a third world country and an emerging market, and they, excuse me, and it's a little bit of higher risk business, that risk is reflected inside of the APY. So the higher the risk, the higher the reward, just like any other investment pools. But yeah, down here, payment advances, gig economy, they've got fintech, debt financing, commercial real estate, all kinds of different options. But yeah, so these are all these credit pools. So, this New Silver pool over here might have 27 million. So what, average house price in America is 400,000 now. So there's probably a little over 100,000 mortgages in this pool set up. So you're pooling your risk with all these things and all these different assets. So if you invest in one of these pools, you're not getting invoices, auto loans, and mortgages. You're just going to get the one asset. So you can make your bet which asset you want to be on. So another way of doing it is how Aave is. So Aave is doing direct liquidity. rather than going through you picking, do you want to do auto loans? Do you want to do invoices? Do you want to do mortgages? They just have a straight money market fund that you put your money into, and they pay you interest and CFG tokens, a Centrifuge. Then Aave actually is the one who takes the checks everything and puts the money into the pools. So Centrifuge can go, hey, our mortgage portfolio needs, $20 million, and our auto loan needs $50 million. And then Aave will go ahead and split that money off into the different pools that's needed. And then the money is off ramped and lent to real world businesses. Remember, these real world businesses aren't actually borrowing the money from DAI. They're going to this bank like New Silver to go ahead and get the loan. And then New Silver is the one taking the assets, putting them on chain, and getting the liquidity to pay them with. So there's intermediaries on both sides of this transaction, the off chain and the on chain.
Question here. So in the last slide, Joaquin, is there any compliance issues? Basically, from DeFi market, the money may not, go through the KYC process. So the investor would be able to use this capital?
In the sense of the companies themselves?
Right. So Aave basically provide a liquidity, right? And then I'm wondering, so for them to then provide the capital to, the lenders, the borrowers, do they require any KYC process?
Yes, like the bank is, so the bank in the lending world is, but the real world businesses are obviously KYCing them, and then Centrifuge is KYCing the financial instruments that are doing this, right? So the entity themselves, like New Silver Mortgage, who's borrowing money from Centrifuge, yes, has gone through a full KYC AML with Centrifuge, and then Centrifuge is working with Aave and on both sides. So basically, like there's 3 steps in between the business and your DeFi investor putting money into the protocol. You've got Aave on the right, you got Centrifuge in the middle, and then you have the banking or the investment company on the left side. So yes, people are KYC'd in between the 3 entities.
But when we users deposit money to Aave market, we don't need any KYC, right?
No, we don't. No.
Yeah, so that's the sense. So when Aave provide the capital to the Centrifuge's pool, how they can provide a proof that the capital, source of the capital has passed KYC process?
That's a great question. I actually don't have the answer to that one. I don't think there is anything checking that. I think Aave is KYC with Centrifuge, and then they're just providing the capital from Aave's money market fund.
Got it. Okay. Thank you.
No problem. Good question.
Yeah. Can I ask a couple of questions? So 2 questions I have, right? One is investors are putting in capital into Aave. So this is in the form of crypto, or this is in the form of fiat, right? This is fiat that's going into Aave.
No. Investors are putting DAI into this pool.
They put it. Okay. So Aave is still using DAI as a stable coin, because now Aave also has launched their own stable coin, but they're still accepting DAI as the preferred format for doing this transaction. Is that correct?
So Aave is taking USDC right now.
Okay.
And Maker's taking DAI.
Got it. So investors are putting USDC into Aave, right? So that is where the RWA market capital is getting created, and then Aave in turn decides which pool of Centrifuge to put in, so there will be variable interest and returns coming from each of those pools. So how do investors know what is the rate of return that they should expect when there is no one particular pool in which they're investing in?
So up here, they've got this real world asset market. This is from Aave, and this is their market, and they're targeting. There we go. Yeah, so if you're depositing into Aave, you're getting a 2.8% on your USDC, and you're getting an extra 4.5% in CFG from Centrifuge token rewards.
Okay, so you're getting a particular return for the USDC, and you're getting CFG returns. So then again, your returns are linked to the performance of the token, right? So there's that element of risk involved in that from an investor's perspective. Got it.
And there's the Aave side. If on the Maker side of things, it's directly you're investing in each one of these pools.
Right. So that is why I was asking, right? So in this case, because Aave is deciding where to put the money, unlike in Maker where which facility the capital is going to. So investors' return is structured very differently. Got it.
Correct. Yeah.
And secondly, in Maker's case, investor is not actually investing with Maker, right? Maker is drawing a line and giving to, let's say, an HVB or whoever they're partnering with. So investor is not getting a chance to participate in that pool at all in the first place, right? So there's no investor in the Maker's case. It's directly Maker doing a wholesale loan to a protocol or a business like HVB, who in turn is then lending it out to whoever they want to offer credit to.
Correct.
Got it. Thanks for those clarifications.
No problem. Thanks for the questions.
Hey, Joe, I have a quick question. So, in the event of bankruptcy or liquidation, do the end investors / token holders have any right to claim the collateral in the court?
The actual holders, no. Maker's the one who actually holds. So in the case of Maker DAO is the one who holds the rights to go ahead and sue for the assets back.
Got it. Thanks.
Yeah, no problem. Anything else before we move on? I got one more weird one for you.
So I'm just wondering, because I was looking at one of the governance proposals of Maker, and one of the challenges that they said is that because Maker or some of those are not really legal entities in that sense, right? They would have limited right to legal recourse in case the loan goes bad. So in case the partner that they're working with is not able to provide them the returns, it would mean a lower return on the overall investment as compared to what they've estimated. So I don't think they have too much of a legal recourse available to them in case some of those loans go bad. They'll just have to take a hit like any other lender in terms of the total return that they are expecting on that particular transaction.
Yeah. Anybody else? We'll just do one crazy weird one. That was kind of rad. All right, so this is Paperchain. Paperchain's a Web 2 company that just recently went Web 3 as well, or add, I guess, another facility to their thing by using TinLake. But so Paperchain is a company that allows content creators to take advances against their earnings. So they have there you go. So they have this dashboard they built, and it's an API feed directly from, say, in the case of music, YouTube, Spotify, Amazon, and Apple Music. And it go ahead and lists through and shows what every 24 hours the artist is making, what they did the last 30 days, the last 60, the last 90. And they go ahead and extrapolate with projections to figure out how much they will make in the future going forward. So they're allowed to go ahead. They have a debit card for the Web 2 world, and the artists can apply for this, plug in all their APIs from the back end of these streaming services, count all their stuff, and they can use that debit card to draw down. Now, of course, there's a fee and interest involved to make sure that Paperchain is making money off of this, but they let their artists go ahead and use a card so you can get access to your money as soon as someone streams your song. So if someone streams your song, bam, that money's available for you to go ahead and swipe your debit card and buy a coffee. So they're putting this on chain now, which is kind of cool, right? So the feed is now the price oracle. And the same case in the sense of like New Silver Mortgage, this is usually like a digital media company, like a record label or a game distributor or a movie production house. They're bundling all their artists together. They're putting that NFT on. They're going ahead and putting in the credit facility, and they're doing the exact same thing we just talked about. They're able to borrow DAI against all the earnings of their artists. This way they can actually finance the money they need to pay. So they're one of the lenders, just like a mortgage company, borrowing money to pay their artists. They're getting the fee by loaning the money out to the artists and advancing it to them, and they're making money off of this. I thought that was a kind of a cool price oracle feed that they're using all these different streaming services so you can have live payments to artists. So it's just a Web 2 company using this real world asset on chain market to go ahead and finance their operations of advancing money to their artists. It's kind of wild, but that's all I got. That's the presentation on real world assets.
Yeah, thanks, Joe. For walking us through. This is super awesome. Two quick questions. So how does Paperchain compare to Royal? And will we get the slide deck at the end of this?
Yeah, I'm happy to share the slide deck. Yeah, I'm not familiar with Royal.
Yeah, so Royal is another music royalty sharing platform set up by Plow, and basically you can buy NFTs to share the streaming revenues with artists such as, I think Little Nas X is on it. I have an NFT from Chainsmokers, for example. So it's somewhat like tangent to what you just described.
Interesting. Is the revenue sharing, is it from like a total streams, or how's the revenue share with the NFT holders?
Yeah, it's from their total streaming revenue on platforms such as like Spotify, like all the names that you know.
Very cool.
Yeah, check it out. It's pretty cool. This is really cool too.
You got one, Isaac?
Oh yeah. First of all, this was awesome. Thank you. Just high level. So in the case of the mortgages, we have like the auditors and other people. What like type of guarantee does Paperchain have? Is it like when you get these royalties, you're 100% guaranteed to be paid out? What happens if, they don't get paid out, they get paid out less? How is that kind of market? Or do you have any insights into how that works or is audited?
Yeah, so each stream when it happens live, so that basically they're keeping track on their dashboard here of what each stream pays and when it comes in, so the artist can borrow money that's already owed. So that money's been booked. It's just waiting for, see what is Spotify, 90 days? They're waiting for their 90 days to get paid out, so they're basically getting the advance on their money and on their money. So.
In Web2 world, this is called receivables financing, where typically if your payment is due to come after a point in time, you get paid today but at a discount. So if you are due to get $100 after 3 months, you get $90 today immediately. So this is a particular kind of a receivable financing on a very specific use case, which is with respect to content creators. And so it's fairly standard. All they've done something interesting of bringing it on chain. So this is actually, yeah, I think perhaps this is a great example of TradeFi meeting DeFi.
Yeah, exactly. Just the handshake, right? So they're going to Maker DAO, they're going to Aave instead of going to a bank to get that financing. So this company, say this record label that has their artists out there, and they're waiting 90 days, they want the advances. Well, that company needs to have the money up front to pay them, right? So they're usually borrowing it from a bank, but now they can borrow it directly on DeFi. So say the record label's capitalized, they don't actually need that to pull that DAI off chain. They can go engage in DeFi yield farming opportunities now, or put it in a different vault to make money if they don't need to pay the artist with it directly. Say they're well capitalized and it's just money. So that can be used for investment purposes as well. There's just giant credit facilities being open. This is pretty standard in all finance with companies having credit lines. This is just a credit line on chain and letting us, the regular user, put our DAI in there or USDC to make capital on it. Plus, it's a whole new liquidity market, right? If you're some small business that can't find a bank to bother with you, you can go ahead and go to Centrifuge and get DAI financing. So it's kind of a cool way of accessing money from people across the world and opening up all this liquidity in DeFi to real world assets.
Yeah, I think this is an awesome example about how Web3 is basically going to pull Web2 into the on-chain world, kicking and screaming, even if they don't have consent to do so. And like, I think you can see it in a lot of cases. Like people have talked about mirroring stocks on chain and participating in that market. And I think it's a cool example of, because in Web3, one of the native things is that you would get paid, like you can use Superfluid to get paid instantly or something like that. But it's cool to see people basically taking initiative and doing that first. And also, I'd imagine, so one of the reasons why they withhold payments, at least OpenSea does this too for this reason, is for risk purposes. Like I guess on Spotify, if they figured out you botted your listens to your songs, and then they have time to figure that out and adjust. So I'd imagine there's some risk, but that's what the fee's for, to make up for it, right?
Yeah, and the cool part is Paperchain's taking that risk, right? They're the ones loaning the money out. Paperchain's the one, the record company who's using this Paperchain thing is the one responsible for paying back the pool, not the individual artist. So the company who's accessing this credit line has the risk, not the individual user. And it's usually on same thing on our side too, like as we are providing liquidity to these pools to get paid out. Maker DAO or Aave are the ones, and Centrifuge, the ones dealing with the companies. We're not individually responsible for one artist or one mortgage. Now we do start taking losses and write downs if 50 mortgages of 100 go bad, but that would have to be a pretty black swan event to go down. Now it's just heavy finance, not super tokenomics, but it was a really interesting use case of what's happening. And Maker just announced their $100 million credit facility with Huntington Bank. out in Pennsylvania, one of the oldest banks in America. And it's just kind of wild for these real world banks to be coming out there. Like for New Silver, right? They're a tech first, fintech startup doing this. So it makes sense for them. But to have a really old school traditional banking banker going out there and utilizing DAI on the blockchain, I think is really kind of a massive signal for what's about to happen to the space. And the bad part is, I don't know what it's going to do for regulation side of things, right? Like we're actually accessing all this capital to bring it into the real world. There's going to be more compliance, right? People are going to need to do, like Centrifuge is going to have to do a lot of compliance. Maker DAO might have to do more compliance now to make all these things work. And we're trusting non-blockchain assets to be valued on chain through third-party companies. So we've removed a lot of the permissionlessness, you've moved a lot of decentralization, and we've removed a lot of the trustless nature that makes blockchain interesting. So it's kind of an ethical question, right? Is this something that's good or bad for the space? So the Maker community had a big, debate about this. Is this good for crypto and Web3 to have all these assets on chain? But I'd love to hear you guys' thoughts.
Yeah, I have a question about regulations. I think I learned that if you then tokenize a real world asset, then the underlying NFT or token then becomes a security. So it falls under the regulation of the SEC or something.
Mariette, you got this one? Yeah, in the US, right, something like this would be handled by a money transmitter. So like this would need to be banking licenses. So all of these banks are KYC'd with Centrifuge, of course, and their licenses are on file. But yeah, once the NFT gets put into this contract, yeah, I'm not sure what the ultimate legalities of that would be. Would the Securities and Exchange Commission say it's a security? It's a debt instrument now, so it would fall under banking regulations. But yeah, the SEC could try to come in and be some jackbooted thugs and try to say it falls under them, and then they'd have to fight in court about who actually has control, right? So whether it's the SEC, is it the CFTC, is it OFAC, like who has the final say on these things?
Yeah, exactly. And really with Hunter, I guess that those kind of business models, they will be successful because, yeah, one can easily see the advantages for, let's say, the artist or other participants in this ecosystem. Hi, cool. Thanks for sharing.
No problem. Yeah, it's a crazy world to explore.
Hey, Joe. So I'm wondering if there's any major challenge for Centrifuge, for doing this business currently.
Just the amount of compliance in the front end to get a company onboarded. From what I was reading through them, they've been around since 2017, building this thing, and they finally went live on Substrate in 2019 after getting it all constructed. And yeah, then it's just been like they have less than 20 lender or 20 credit facilities total open. So that's 4 years of work to get 20 things open. I'm sure it'll go faster now that Maker's integrated it and Compound is integrating it and Aave already has. It's just I think it's a battle of attrition of slowly getting these companies to onboard and trust this. Because what's the big friction point, right? Like if you're a bank and you need money, you have to go get a MetaMask, get your chain, get on chain, use your wallet, go make the transaction, withdraw the DAI, then take your DAI, turn it into dollars, and put the dollars in your account. So there's a really lot of steps to access this credit. It's a lot harder than just ringing up a Daddy Warbucks over at the bank down the street to wire it to you. I'm sure it's probably cheaper in gas fees than it would be in wire fees. Wire fees are insane. But I'm not sure if this is a cheaper alternative or just a easier alternative or a faster one. Like what's the value proposition for the lender, right? It's just liquidity. It's easier to access if you're a small lender. But I'm not sure if Bank of America would do something like this.
Mm-hmm. Actually, it make me think about another project. So basically, they try to mint the traditional like a certificate for the house as a NFT, and fundraising through the online. And then the challenge for them is like how to make sure the status of the real estate properties match the data on chain. So that's created a lot of a challenge, because it's kind of very expensive to hiring the third-party agency, to keep tracking the how the condition of those real estate properties. So I don't know if that would have the Centrifuge would have the similar challenge, because they are hiring the third-party but here maybe easier because it's about a trading, right? So it's not some like property have a lot of depreciation or I don't know wares.
Yeah, no, it's like that's why we're this right now. The first iteration of this is all debt instruments. That's why it's invoices and accounts receivable, and why it's mortgages rather than being houses themselves, because the prices aren't varying. That price is set when the document's hashed, right? So they're anchoring it on chain by hashing the document, and then all these people are making sure that document is good before it's put on chain as an NFT. So I guess with the house people who are trying to do crowdsource real estate through DAOs and NFT to houses they're purchasing, that is really hard, right? How do you handle depreciation? How do you handle taxes? How do you handle dividend payouts? If 100 people co-own the house and then you're going to make 100 wallet deposits, like good luck paying for the gas and all the work on the front end to get your $17 in rent this month if you own 1/100th of a house.
Thank you.
So
Thank you.
correct me if I'm wrong, Joe, but Centrifuge is just a tech platform, right? Centrifuge is not assuming the risk of the credit that's getting disbursed through the platform. There is a loan originator and asset originator sitting in front of Centrifuge, right? Which is the one who is taking the credit risk and who owns essentially the end customer, right?
Yeah, so it's the buyer and the seller, and then it's the other side. It's the credit facility they're getting the money from, right? So in the case of mortgages, it's the buyer, the lender, which would be the credit facility, and they're the ones sitting on chain.
Right. So Centrifuge is just a tech platform which is enabling RWA assets on blockchain. All right, and they're getting a particular fees for enabling that transaction to happen.
Yeah, and they're also the ones onboarding the credit facilities. They're KYCing the banks and the lenders inside or the borrowers inside of this program to make sure they're vetted and they're good.
Right.
Well, all right, that's it. I'm gonna give everybody 8 minutes of their lives back. Any last questions? I'm happy to answer them before I take off. But I appreciate y'all coming. Thanks for listening to me fire hose you the finance information for 52 minutes. And thanks for coming, Isaac. Appreciate the support.
Yeah, go team. You crushed it, Joe. Thank you.
Thank you, Joe. That was amazing.
I had to keep up with you, man. You crushed it last week.
Thank you, Joe. I really appreciated it.
And thanks for the great questions from our legal department.
Thanks, Joe.
Thank you, Joe. Thank you, Joe.
Thanks for organizing this. And a timely note on the other group, which kind of made me aware that this is happening. So thanks for that.
No problem.